So you have access to some cash and you're not exactly sure which route to take. Should you take some of this and invest in your property to bring down your bond? Or should you look at investing this and taking some of that interest to pay towards the bond? Well, this video is going to give you guidance on 3 important aspects that you want to consider in order to make this important decision. Now, perhaps towards the end of the video, I might throw in a bonus one, which is critically important for you to know, but let's see how we go. Let's get started. Now, the first thing that I want you to consider when making this decision is you want to start to analyze interest. And interest is either earned or interest is saved. So one or the other. And in the case of you investing the money inside a bank account, so let's just say you had to invest and you're using a bank to do that investment, you'd be earning some kind of interest in that bank account. And we would compare that interest versus interest that would be saved. So we'll put this, we'll say interest saved. And straight off the bat, it might seem like this is something that is simple to compare, because you might have a look at the interest that you are earning on your bank investment, and let's just assume the interest rate is 7%. So that's the interest that the bank is paying you. And if you've got a good credit profile, let's assume that the interest that you actually have, you've been charged on your bond is 5%. Which means if you had to put this money into your bond, you're only saving 5% on interest. Whereas if you had to invest this money in a bank fixed deposit, for example, let's assume the interest rate is 7%. So then you might be leaning on the route of going with a bank interest because 7% is a lot higher than the 5%. So this is a way in which you could grow wealth, right? But what you want to have a look at closer is what happens from a tax perspective. So yes, on this end, you are earning interest and it's 7, it's a higher percent, but the higher interest is then meaning that you're going to receive an additional form of income. So from a tax perspective, you now have a second source of income. So quickly, let's have a look at how SARS is going to see this. You're earning a salary. So I'll put this pool as your salary. And then you have some money that's invested in the bank account, and that bank account is bringing you some interest. Now, I'm using bank account in my example because I'm looking at a fixed interest that you're getting, not a unit trust investment. I'll tackle unit trust investments next. But what SARS does from a tax perspective is they're going to add both these amounts up. So they're going to add both amounts and they're going to tax you on that amount. Now, if you know, our tax system works according to a sliding scale, meaning the more income you earn, the more tax you're going to pay. So what could possibly happen here is the interest that you earn, if it's high, it could shoot you up into the next tax bracket, meaning you could end up paying more tax. Now, it's could because I don't know your full set of circumstances. What could influence this? Well, it's the following aspects. And these are just some of it that could influence. One, you could be married, and if you're married in community or property, then the interest gets shared between you and your spouse. So if the interest was 100,000, in essence, you would earn 50,000 and your spouse is earning 50,000. That's how SARS would see this. The second thing is what SARS calls an exemption. Now, the interest exemption for individuals below 65 is 23,800 at the time of doing this video. And if you're above 65, it's 34,500. What does this mean? It means if you are earning interest and you are under 65, and that interest is 23,800, you won't pay tax on it, meaning it's not actually going to be added to your salary. There's an exemption. Let's use an example. If the interest was 10,000 and you are less than 65 years of age, in that case, you're not actually paying any tax. If it's more than 23,800, then you're paying on the difference. So for example, if your interest is 25,800 in the example, so let's put that in to make it look easy for you. If your interest earned is 25,800, then you 2,000 Rand more, and that 2,000 Rand now becomes taxable. And I'll talk you through that. Just quickly, if you are over 65, then the interest exemption increases. So you now have 34,000. So you can earn a lot more interest, and without having to be concerned about the tax there if you are over 65. Now we want to have a look at why this is so important, because often individuals don't consider this. And because it's simple to look at interest that you're earning in a bank versus interest that you're paying on your bond. It's simple just to see that figure. You can easily make the decision to say, look, you want to now invest it in the bank and earn that interest. But let's take a closer look here. Whatever interest is above the exempted amount, whatever interest is going to be added to your salary, if that pushes you up a tax bracket, or if you're already on a high tax bracket, let's just say tax share is 30% for you, which means technically you didn't earn that amount of interest. And why this can be a bit tricky is you only get to see this at the end of the tax year. So that's really the only time that you're getting to know you are either paying in some money in tax, or the refund that you could have received is now a bit lower because of the fact that you have a secondary source of income. So your tax refund is a lot less. Now, that's why it's confusing, because you only get to see that at the end. It's not something that is happening on a monthly basis for you to track. And also, if 30% is going away, if a big chunk of it's going away, then if you have a look at it, you're not actually earning 7%. You're earning less than 7%. So you minus that return, you might even come to a break even, or you might find that although the interest rate is higher at the bank, you actually are in a position where your wealth is not growing, because it was cheaper, more cost effective for you to throw this money into a bank, into your bond itself. So I hope that one makes sense. And now, what happens if you had to go with a unit trust investment? Now you want to consider risk inside a unit trust investment, and we're comparing the risk here against both places. So what's the risk if you had to take this money and you put it into a bank account, your bond rather? What's the risk? Versus if you had to go to a unit trust investment. Now, by nature, unit trust investments do not offer guarantees, which means they're exposed to the markets. There's times when the markets are performing well and times when it's not performing well. Now, you could get a low-risk unit trust, which is sort of like a money market investment, but then the interest is going to be low. And again, you want to start comparing against your bond. Now, if you get into a vehicle that is high in risk, now you want to be mindful. Over a long period of time, high-risk investments tend to become feasible because you have time to invest, you can sort of weather the storm. But in the short period, these investments are a bit risky. And what you want to consider is what would happen if you started your investment when the markets are performing well, and suddenly there's a market crash, and you end up losing 10% of your money. Now that could be 1,000 Rand, it could be 20,000, it could be 100,000. And how confident would you be to remain investing if you happen to stomach a loss? Would you be able to continue investing despite the market dip? Or would you just feel you could lose more of your money and now you want to move away? Now, these are some of the things that you want to analyze before making this decision. And you can see you can do that in advance before you go in. So that's from a risk perspective on unit trust side. Now, if we have a look at this from your bank investment, what takes place on the bond side is your risk itself is quite low, because the only risk that you have comes in terms of the property. Now, if you've done your homework, you've invested inside a good property, you've chosen a good area, good neighborhood, chances are the value of that property is going to be growing, which means your wealth is growing. So from a risk perspective, it might be lower risk to go into a bond, put that money into your bond versus a unit trust investment. And that takes me to the next one, which is liquidity. And liquidity simply means how easy it is for you to gain access to your money. So liquidity. Now, you want to factor life happens. So you might need access to money for some kind of emergency. You might just need access to money because you've had a change in your lifestyle. But whatever takes place, you want to determine how easy it is for you to access money. Now, if you're inside, let's say, a bank fixed deposit, so if you had put this into an investment and it's a fixed deposit, let's say a year or 2 years, suddenly you want to analyze the penalty. Now, is there a penalty for you to withdraw your money from here? If that's the case, it compromises your liquidity. If you had to take this money and you put it into your bond, you want to analyze whether you have what's called an access bond, meaning are you able to access this money beforehand, and how easy it is for you to gain access to the surplus that you put in. So that can create the liquidity for you. And then from a unit trust perspective, this is where you want to be extremely mindful, because you can't control the markets, and you also can't control when an emergency might come along. So if the emergency comes along when the markets are performing well, that's good for you, because then you can access the money at a time where markets are good and you've made your profit. You've got some kind of return. But if the emergency happens and suddenly there's a market dip, now you're finding yourself in a position where you could actually be getting out less than what you put in, which changes the whole dynamics of this. So you want to be extremely mindful when you're considering what's the right vehicle. Now, what's the bonus one? This is actually something that most people overlook. And I want you to pay very, very careful attention to this. Again, it's one of those things that tends to creep up on us, and we actually don't know when this may take place. You probably know where I'm leaning on here, and this is in the event of you passing away. Now, in the event of you passing away, I want you to bear in mind that when it comes to your bank account is actually going to be frozen. So this money is going to be frozen, and that money will then form part of your estate. The executor would then start this process of winding your estate. All the money is then pooled into what's called an estate-led bank account, and then all your liabilities are settled, all of that account and things like that. But the process can take a while. This can take up to a year. In some instances, it can take longer. Now, in cases like that, I want you just to think about family, your loved ones. Are they in a position to manage financially? Can they manage paying for the bond up until this process is completed? So that's what I want you to give thought to, because money that sits inside bank accounts ends up being frozen. On the flip side, if you're taking this money and you are investing it into your bond, what I want you to be mindful of is, yeah, that could be good because you could have the bond settled, or you're reducing the balance. So that's a positive, but you still need to make sure that you have some kind of liquidity in order to cover the estate expenses. Now, why is this key? Because at the time of you passing away, or any one of us passing away, SARS deems that you have sold your property. So they take it as though you sold your property, which means it could trigger what's called capital gains tax. It could trigger estate duty, depending on what your will has said here, how you've moved this along. But you're also going to have costs, because you're going to have executor costs for the executor to do the winding of the estate. So executor fees, plus you're going to have attorney's costs because you want to transfer that property to to whomever you will this to. Now, you have to make sure that you've got provision for these costs, see? Because if you don't, you run the risk where the executor doesn't have a liquidity, your family members don't have access to this money, and suddenly you've got an asset now that's getting sold, and in order to pay these estate fees, and then you know what happens. You're not going to get the correct value for your property. So you want to take care of this. There's many ways in which you could deal with it. One is obviously settling the bond as soon as possible. You could take some kind of bond protection, or have a life cover that pays into the estate to cover these estate fees. But you want to analyze these areas very carefully in order to make the most appropriate decision. Now, I hope you found the video insightful. I want to know from you which of these techniques you found most beneficial to you. And if there's a new technique, if there's something that you've tried that you found has worked, I want you to post it in the comment below so that we're able to create a guide here that can serve for other members who are in your position and help benefit them. Now, if you've not already done so, please subscribe to the channel so I can share with you more secrets on how you can start to grow your wealth and save on tax.